Troublesome conditions are upon us now, and we see that this is a global policy that is taking place. Today, we will discuss the financial crisis part 2 that is imminent as the debt climbs. You came here for the truth, so let me unveil that for you. Right before I get into this, I just wanted to note you can pause the video to see the little fun changes that I made to this image right here. So we're going to move on to this image. It's a little pixelated, but I'll just tell you what it's all about. Right here in Bangkok, Thailand, we are seeing this advertisement on a billboard for the RMB, also known as the renminbi or the yuan, China's currency, suggesting the new choice for the world's reserve currency. This is incredible information that they're actually here advertising it on a billboard in the nearby region there in Thailand. So this is pretty amazing to see this kind of information. Now, of course, this is something that will take many years to complete. It's not going to happen tomorrow. You're not going to just wake up one day and find a new world's reserve currency like this. It will definitely take many years to complete, but we know specifically that the world is heading in this direction. We have seen the currency wars taking place. I've been covering it here. So let's move on to one example of that. National Bank of Kazakhstan announced about measures on reduction of economy's dollarization. The National Bank of Kazakhstan, jointly with the government, developed an action plan on reduction of the dollarization of the economy for 2015-2016. Now, you might be thinking, well, this is Kazakhstan. They're a small country. They don't make waves in the economy, in the geopolitical sphere. Now, that may be true directly, but think about the fact that Kazakhstan is part of the SCO, the Shanghai Cooperation Organization, and what we have with that is a set of countries, including Russia, including China, that certainly do make waves. And this is very important because they're partnered up with them, and they're saying, we want to get away from the dollar. And this is just one of countless countries that are going in that direction. I've been covering it here, of course. So we'll move on to China once again. The nation is paying a price for economic structural adjustment reflected in commercial banks surging non-performing loans. They are headed in the exact same direction that the US was during the financial crisis, where they were giving out money to people who shouldn't have had it. And then we saw what happened, particularly with the subprime mortgages. To avert further risks, the People's Bank of China may take measures to control the expansion of debt. They're putting a damper on this because they know that the hot money is flowing inward, and of course this causes major problems, major dislocations. Difficulties are increasing for the central bank to manage liquidity. The traditional measures of increasing money supply based on the position for foreign exchange purchases is no longer efficient, and the uncertainty of capital flows is increasing. They must do this now, and unfortunately for them, this is really going to hurt their growth at this time when we already have a decline in their growth. You can continue to read on from the China Daily information here. There's lots of info about what's happening in China. We definitely see a slowdown there. They're not in the negative territory, that's for sure, but it is definitely a slowdown when you talk about a crisis in China. Not having it growing at an extremely high number compared to other countries is actually worrisome for them compared to, this historical analysis. So I'm going to move on right here so we have so much to cover. Poland's central bank cut borrowing costs more than estimated in what economists described as the last attempt to nudge the economy away from a deflationary spiral. It isn't just Western Europe that is affected by a deflation. We look over at Japan having the same issue, and other nations, right here, Poland being one example, that's suffering the same. And what they will do is engage in the same policies as all of the rest, and that is low interest rates and massive quantitative easing, but only after the deflation gets bad, and they will react, over-exaggerate that reaction. The Monetary Policy Council lowered its benchmark 7-day reference rate by 50 basis points to 1.5%, a record low. And that's exactly what I wanted to cover, the fact that we are moving into record low levels now. We are seeing the Lehman crisis era coming back, and we are actually, in many indicators that I've shown here, actually going back even further. So, of course, this is obviously presenting them with a problem, because when you get to record low levels of anything, how can you ever come back from that? This is the struggle, that it isn't just Poland that's going to face this. It is practically every nation. We saw how many countries have lowered their interest rates in 2015 alone. This is very worrisome information. You can continue on with the article for yourself. Out of Bloomberg, I just wanted to show you this as well. Just some telling information about the grocery stores versus restaurants and bars. People are spending more money in the restaurants than they are in the grocery stores in the US. And this is a big change right here. And this goes to show you how things can change in a few short years in particular. And this is a trajectory that is obviously going, you can see the chart for yourself, actually almost in an exponential gain for the restaurants here. So I'll move on to talk about the American consumer. They are the engine for the global economy and have been for decades. The hope is that despite the current problems, it's going to pick up again, and the growth will outweigh their debt. This is a quote from my book. Obviously, we have a big issue when the American consumer is essentially keeping the entire world spinning, and they think that as long as they can buy more stuff, then the debt that's accumulating, well, then you're going to be okay. But in fact, we're looking at more debt today than the GDP. So this is wearing out very quickly. Even after all of this money printing, even after all the low interest rates, we have a crisis that is here. If the crutch is removed from the system, the economy will undoubtedly collapse. And that is obvious. That is so obvious when you look at it. More debt than the GDP, and the GDP numbers are completely fake. So when you look into it, you know that the situation is nothing short of terrible. Let's move on to this. Net worth and the GDP ratio may be signaling an asset bubble now, and that's, maybe. Well, I really think it is pretty obvious. So we'll go back just to the previous two crashes there, and they're looking at the bubbles in the year 2000 as well as the one approximately year 2008, and they showed bubble territory, and we are right up at the top today. And of course, when you look at real indicators like this one, you get this type of information. So the drop that we can expect to see would really put a damper on the wealth of the average citizen, and also the stock markets and the pension funds and everything that is interconnected. So this is pretty obvious. You can see where we are headed. This is just one indicator I want to show you. Failed breakout, the NYSE composite. Now, I'm not a big fan of these type of 200-day moving averages and all these sort of things. The technical analysis is okay, but I like to just use it to support my fundamental analysis. So this right here being a failed breakout, I believe this chart is actually from approximately 2 days ago, but I just wanted to show you that all of these companies, the financial advisors, they're always looking at charts. They're always looking at this sort of micro analysis and not looking at the wider picture. And that is what is so crucial. Yes, you can look at these charts and have an idea, and really analyze them and think about them and add that to your fundamental analysis in order to paint a picture. But when we have these individuals who are controlling what's in our pension funds and who are there buying up billions and trillions of dollars worth of all these stocks and the foreign currency markets, they are oftentimes looking solely at these charts. And that is very, very frightening to think about when you're not looking at the wider picture and all of the different things that could happen to bring this market down. No stock indicator, no chart is ever going to be able to predict some of the things that we could face. This right here is just some information showing you the accumulation of the GDP over the course of the month. Pretty interesting to look at, and just wanted to show you by the end of the month, look at the decline of 1.2% GDP statistic that they're showing here. I've been getting into this, of course, and when you have these type of indicators like GDP that is declining, and even though they showed us a 5% GDP not too long ago, we can see how rapidly things can change. This is completely false and fraudulent, but of course this number will get the stock market booming as long as it's in positive territory. And this is something that I needed to show you here. And it is very concerning to me because what we saw during the financial crisis and prior to that with the subprime crisis and so on. 3 big private equity firms are betting that the so-called landlord loans to small and mid-sized investors will become the next big opportunity to profit from the rebound in the U.S. housing market. That's right. Don't let it crash to the natural levels. Just take on Fannie Mae, take on Freddie Mac, put them onto the backs of the taxpayers, and this will solve all the problems. When you have massive quantities of people invested in the housing market, don't let it collapse. Don't let it go back down to the region where it should be. You need to support that. Put the crutch in place. And that's exactly what has been happening ever since. The private equity firms are providing financing indirectly to hundreds of real estate funds by buying single-family homes, something that until recently was not available. They're doing everything they can to spur the growth of every single asset class, every single possible market out there. And the real estate market is obviously in trouble, and for good reason, because they had a crisis that they brought on themselves. So here they are once again trying to pump up the market, and it is as if having practically free mortgages out there to pump it up isn't enough. You need all sorts of money being flowing into hands, as we saw in a few articles ago with China having to really put a stop on a lot of the things that's been happening simply because they let it get too hot. And this here is about the UK. UK retreat from investment banking gathers pace. Very dangerous here. This is out of the Financial Times. Britain's retreat from the investment banking is set to accelerate as RBS aims to slash as many as 14,000 jobs in this sector. And Barclays chief executive says he has limited patience with the business. Why would this be the case if we are in a recovery? Well, the fact is that we are simply not in a recovery, not even close. They slashed so many jobs during the financial crisis. We saw this, I covered it in my book, in fact, about how they were slashing hundreds of thousands of jobs in this field. And, you know, they did start to hire people back, but it seems like they're once again having to lay people off because of the chaos that is really created from these same institutions. They're creating their own problem. They have trillions upon trillions of derivatives on their back, and they're not stepping off of the gas pedal at all. In fact, they're doubling down on all of their gambling. We know exactly where this is headed. If you found this video informative, please give me a thumbs up. I really appreciate that. I have emailed all and replied to all of the insiders. Got to all of you. Thank you very much for that. I'm sending out some new insider emails, so stay tuned for that. The live Q&A, I've been asked about that. It's still coming. I'm just trying to get some of the other work done. I'm finishing up some other tasks, but I definitely still want to do the live Q&A. I also wanted to say, I replied to a couple videos back. I'm trying to, get to all the comments, as many as I can. I generally reply to about 2 days worth of comments, and that's about all I can get to. And just the current day's video as well as the previous day's video. I also wanted to let you know that I continue constantly to post videos. I try as hard as I can to post every single day. I stay up as late as I possibly can, as far as I need to get this information out there. I really believe that this is making a difference in the world. If you want to get the latest and greatest intel, all you need to do is go over to themoneygps.com. You scroll down to the bottom and you fill in your email address, and you get occasional emails from me with good, short, concise info.